Hey, what's up, everybody? Tim Albrecht here, and welcome to this week's episode of the Ask a YFP CFP segment of the Your Financial Pharmacist Podcast, where we feature questions from you, the YFP community, to be answered by one of our very own fee-only certified financial planners. Please note this podcast is intended for educational purposes and should not be considered financial or investment advice, as we do not know all the variables to one's personal situation when answering a question. Before we jump into today's question, a shout out to our extraordinary YFP financial planning team that makes this segment possible. Your Financial Pharmacist offers fee-only comprehensive financial planning services that are customized to the pharmacy professional. So whether you want to pay off your student loans, make the right investment decisions, or simply build a solid financial plan, we'll help get your income working for you rather than the other way around. You can learn more by visiting yfpplanning.com. Again, that's yfpplanning.com. Okay, this week's question comes from Christina in Dayton, Ohio.
Hi, my name is Christina. I'm from Dayton, Ohio. I graduated this year from pharmacy school, and I have about $125,000 of federal unsubsidized loans. They're in their grace period until December, and their interest is frozen through then. The interest is between 5.3 and 6.6%, and I haven't paid anything on them yet. My parents told me they want to help give me some money to pay down my loans, about 10% of the value. My question is, what's the best strategy? Is it possible for them to do this without being taxed? And should I pay part of the loan interest myself to qualify for the federal student loan tax deduction in order to trigger like a tax return? My goal is to pay my loans off in about 5 to 10 years. Thank you so much for your input.
Thank you, Christina, for submitting your question to be featured on this week's Ask a YFP CFP segment of the Your Financial Pharmacist Podcast. Tim Baker, what are your thoughts?
So the question about, really, I think two questions, right? So parents, if they help, will that trigger any type of tax? And then, should I pay to get the tax deduction, et cetera? So the first question to tackle is about the tax issue. So what your parents can do is that there's something called the annual gift exclusion. And the annual gift exclusion in 2020 is $15,000 per year per person. So this is the amount of money that one person may transfer to another as a gift without incurring a gift tax or affect what's called the unified credit. And I'll get into what the unified credit is. And this could be transferred, the gift can be in cash. It could be in other, assets like stock or something like that. So basically, Christina, your parents can give you $30,000 per year without triggering any type of like taxable event, which is pretty sweet. So now, if it were like, if they were to give you, say, 35,000, which again, I think the amount of money we're talking about, 10% of 125, it's 12.5. You're completely okay. But if this were to happen for whatever reason, then they would just file what's called Form 709 for their taxes, and then it would basically be really just a record. And even with that record, they're probably not going to pay any tax on that, because the unified credit that I talked about is like you'll pay basically a state tax or gift tax on anything that's above, like, I think the number in 2020 is $11.8 million. So the 709 basically is a number that is tracked against that number, if that makes sense. And this number moves up. I know when I was learning about this, it was like 5.5 million. So the idea is like, if I died with an estate of 6 million, that I would be taxed on $500,000 estate tax. So what a lot of wealthy people do is that they give away their estate as they go, but they can only do so much of that per year, which is that $15,000 per person. So not to get too much in the weeds, but at the end of the day, your parents are going to be fine if they basically do that 12,500, and they don't really even have to record anything. You're good to go. So yeah, that would be a great benefit, a great, thing for your parents to do, is to help kind of, put a dent into those loans for you. Now, the question of the tax deduction, yes, basically you can deduct up to $2,500 per year on the interest that you paid. Now, the tricky part is that, in the grace period that you're in through December, you're really not paying, you're not making payments, right. You're not really paying interest. So what you could potentially do is, even before the grace period is up, you could say, hey, thanks, mom and dad, 12,500 or thereabouts is awesome. Definitely going to put a dent in there. You could take some of those dollars and call up your servicer and basically say, I want to apply this completely to the interest before basically it moves from the grace period where you go into repayment and then the interest capitalizes, which means that it moves into the principal column, and then that principal now is accruing more interest post, going into the new year. So that's probably, so then you could write off again, if we're assuming that your income for 2020 is going to be basically $65,000 or less, which could be, I think we said we graduated this year. So yeah, that could be a thing. So basically the phase out for a single filer is 65,000, and then it starts to phase out, and it's completely phased out by 80,000 in basically an AGI. So that would probably be the strategy is, thanks mom and dad for the cash money, call the servicer up and at least pay. I would probably apply as much of that right to the interest. And again, full caveat here is, if you are pursuing like a forgiveness option, I probably wouldn't do any of this stuff. So, but I think the goal, so Christina, you said the goal is to pay it off in 5 to 10 years. I would basically say, apply that to the interest. The interest, then the interest column is less. When it does capitalize, when you go into repayment, that goes into the balance, and then that accrues interest. But then you'd be able to deduct that full $2,500 in tax year 2020. So that would probably be my strategy going forward.
Tim, to make sure I'm understanding and clarify here, doing this in 2020 here would be important for Christina. So if we assume she's the 2020 grad, only has a half of your income, obviously that AGI threshold will be important. But if it doesn't happen in 2020, unless she's completing residency, very well, she would exceed that AGI in 2021, correct?
Yeah, more than likely. Yeah, absolutely. So it's important on that front in terms of the AGI, and it's also so like next year, Christina, you're probably not going to be able to get the deduction because you're going to make too much. And then the second piece of it is the window right now to basically pay down some of the interest before it capitalizes. Like once we get into January and you go into a repayment status, then the interest that is accrued over the, basically since the loans originated are going to dump into the principal column. And then that interest, what was interest is now principal, and it's going to start accruing other interest. So to me, if you can put a dent into that interest before it capitalizes, that's going to be a big step. So really, it's important to do this between now and the rest of the year. So hopefully we'll definitely publish this before the end of the year, but hopefully, you can kind of get that going.
So 3 thank you cards and a hug to mom and dad.
Yeah.
One for the cash money, 2 for the deduction, and 3 for saving on future capitalized interest, and a hug for just being awesome parents for making that a priority. So
Heck yeah.
Great stuff, Christina. Thank you for taking your time to submit the question to be featured on this week's Ask the YFP CFP segment of the podcast. As a small thank you, we're going to be sending you a super comfy YFP t-shirt. And to the community, if you'd like to have your question featured on an upcoming episode, please go to yourfinancialpharmacist.com/ask YFP or shoot us an email at info@yourfinancialpharmacist.com. Have a great rest of your week.